Welcome back to the deep dive. We are doing something a little different today. Usually we tackle a broad concept or a historical event, but today we are opening a specific file. It's a file that affects millions of homeowners. Yet, judging by this stack of research on my desk, maybe 1% of them actually understand the machinery inside it.
Yeah, that sounds about right.
We are talking about the adjustable rate mortgage, or the ARM.
The ARM. It's funny. That acronym brings up such a visceral reaction depending on who you're talking to.
Oh, absolutely.
If you talk to a theoretical economist, they see a tool of, incredible efficiency and flexibility. But if you talk to someone who lost their home in 2008 or someone who works in consumer advocacy,
It's a different story.
that acronym is basically a weapon of mass destruction.
That is the vibe I'm getting from these sources. It is so polarizing. And I think for most people, myself included, before I read all this, the knowledge just stops at the name. You see ARM, you think variable rate, you think, okay, my payment might change. And that's it. You look at the monthly payment, ask if you can afford it, and you sign the paper.
And that's the danger.
But looking through this research, the reality is so much more complicated. It's not just a loan, is it? It's a mechanism for transferring risk.
That is the perfect way to frame this entire conversation. If you take nothing else away from this deep dive, I want you to understand that an ARM is a machine designed to shift the burden of uncertainty.
A machine.
Think about it this way. When you take out a mortgage, you are engaging in a massive financial bet on the future of the global economy. The question is, who is taking that bet? You or the bank?
Risk transfer is such a polite phrase, though. It sounds like something an actuary does in a quiet office. But let's ground this. What does that actually mean for the person sitting at the kitchen table paying their bills?
Okay, let's contrast it with the good old fixed-rate mortgage. In a standard 30-year fixed loan, you are essentially buying insurance.
Insurance.
You are paying a premium. It's baked in as a slightly higher interest rate to make sure that no matter what happens in the world, no matter if inflation hits 10% or the Federal Reserve goes crazy,
My bill is the same.
your bill is exactly $2,000 a month, period. The bank holds all that interest rate risk. If the cost of money goes up, the bank loses. And you win.
Right. I'm paying for peace of mind. I'm locking in my reality for the next 30 years.
Exactly. But with an adjustable rate mortgage, the bank is coming to you and saying, we don't want to sell you that insurance anymore. We want you to be the insurance company.
Wait, I'm the insurance company.
Right.
For the bank.
You are insuring the bank's profit margin. If their costs go up, you pay them more. If their costs go down, you pay them less. You are tethering your family's budget directly to the volatility of Wall Street and the yield curve.
Which, when you put it that way, sounds absolutely insane. Why would I ever agree to act as a shock absorber for a billion-dollar bank? They have the reserves, a checking account.
The price tag, that's the hook. That is always the hook. Because you're agreeing to take on that terrifying risk. The bank rewards you. They give you a lower starting interest rate compared to a fixed loan.
The teaser.
The teaser rate, exactly. It's a trade-off. You get affordability today in exchange for total uncertainty tomorrow.
So it's a gamble. I'm betting rates stay low.
Yeah.
The bank is protecting itself in case they don't.
It is a gamble. But here's where it gets really interesting and a little counterintuitive. We have some scholarly perspectives in the source stack that argue borrowers should generally prefer ARMs.
Really? Even with the risk of my payment just exploding.
The argument is based on long-term averages. Historically, short-term interest rates are usually lower than long-term fixed rates. That's just how the yield curve normally works.
Okay.
So the theory goes, even if your rate fluctuates up and down, the average rate you pay over 10 or 15 years will likely be lower than that expensive insurance premium you pay for a 30-year fixed rate.
Okay, I see the math there. I get it on a spreadsheet. But that assumes I can survive the bad years.
That's the key.
An average works great in a model, but in real life, one bad month where my payment doubles can ruin me. I can't eat my average savings if I've been foreclosed on.
Precisely. And that is the huge disconnect between economic theory and household reality. The model assumes the borrower has financial resilience, which is a fancy way of saying you have enough cash sitting around to handle the shocks.
But that's not why people take these loans.
No. Most people taking ARMs are doing it because they are stretched thin and they need that lower initial payment just to get in the door of the house in the first place.
So the people least able to handle the shock are the ones signing up for the shock absorber product.
That is the irony at the heart of the ARM market. And that's why our mission today is to decode the jargon. We see these terms in the documents. Indices, margins, negative amortization, recast triggers.
It's a whole other language.
It is, and we need to unpack what those mean, because they aren't just fine print. They are the gears in that risk transfer machine. And as we will see later in this discussion, that machine has a history of breaking down, we're talking errors, scandals, and billions of dollars in overcharges.
That part of the research actually blew my mind. The error rates we're going to talk about later.
Mm.
I don't want to spoil it, but it's terrifying.
It's stunning.
But let's start at the foundation, the architecture. If I sign an ARM, how is my rate actually built? Because it's not just some random number the bank CEO picks out of a hat, right?
No, not at all. It is a very strict mathematical formula, and it has two distinct components. You have the index and you have the margin.
Index and margin.
If you want a visual, think of the index as the moving part, like the tide in the ocean. It goes up and down, and the margin is a fixed pier built on top of that tide. Your rate is the top of that pier.
Okay, let's unpack the index first. This is the variable part, the tide.
Correct. The index is a published financial benchmark. It's meant to reflect the lender's cost of borrowing on the credit markets. Critically, it is objective, it is public, and it moves up and down with the economy.
And the source lists a few of these, and some of them sound like alphabet soup. We have the CMT.
The constant maturity Treasury, that's tied to U.S. Treasury securities. It's very common, very stable. It basically tracks what the U.S. government pays to borrow money.
And there's one that caught my eye, COFI, the Cost of Funds Index. But it says specifically the 11th district. Why does the geography matter here?
This is one of the most interesting nuances in the history of ARMs. The 11th District Cost of Funds Index tracks the weighted average cost of funds for savings institutions in Arizona, California, and Nevada.
So it's a regional thing.
Yeah.
But why would a borrower in, say, Florida care if their loan is tied to Nevada banks versus the U.S. Treasury? What's the practical difference?
The speed. It's all about the speed of change. KFI was historically known as a lagging index. It moved like a giant cruise ship, not a speedboat.
A cruise ship. I like that.
If the Fed raised rates today, other indices might jump tomorrow. But COFI, it might take months to fully reflect that change because it's based on a weighted average of what banks are paying on old savings accounts and CDs over time.
I see. So if I'm a borrower and I see a storm coming, interest rates are hiking up, COFI gives me a head start, a little breathing room before my payment goes up.
Exactly. It gives you a buffer. It was a very borrower-friendly index for that reason, whereas LIBOR,
the London Interbank offered rate. Now that sounds important. Is that the speedboat?
LIBOR is the raw nerve of the global banking system. Or it was. It's largely been phased out now after some major scandals. But for decades, it was the king.
Right, the rate fixing.
The rate fixing, yeah. But its function was to be the rate at which major global banks lend to one another overnight. It reacts instantly to global tension, credit crunches, or policy changes. If you are tied to LIBOR, you are feeling the market's pulse in real time. No lag at all.
And interestingly, the source mentions the CPI, the Consumer Price Index, can be used too, tying my mortgage to the price of milk and gas.
It can be, though it's less common. That ties your mortgage to inflation directly. But there is one other type of index mentioned that should raise a massive red flag for any listener. Some lenders use their own internal costs of funds as the index.
That sounds incredibly suspicious. It's like, I've investigated myself and found that my costs have gone up, so you need to pay me more.
It certainly creates a massive conflict of interest. It allows for what we might call profit margin padding. If the index isn't a neutral third-party number like Treasuries or LIBOR, the borrower has to trust the lender implicitly. And in finance, trust is good, but verification is always better.
Which is a tall order for the average person.
Oh,
Okay,
yeah.
so that's the index. It moves. That's the tide. Now talk to me about the margin. You said this is the fixed pier.
Right. The margin is the lender's profit. It is
Yeah.
a set percentage that gets added on top of the index. And this is key. It typically stays fixed for the entire 30-year life of the loan.
So it never changes.
Never. So if your margin is, say, 2% and the index is at 4%, your rate is 6%. If the index jumps to 8%, your rate becomes 10%. The margin is the constant markup.
And the source says this margin is usually between 2% and 7%. That's a pretty wide range.
It is a wide range, yes. It depends on the lender, the product, your credit score, all sorts of factors. And this leads us to a really critical term, the fully indexed rate.
Which is just the formula, index plus margin, the real price of the loan.
Exactly. It's the true market rate for your loan on any given day. But here is the trap. Most ARMs don't start at the fully indexed rate. They start with a teaser.
The teaser rate. The
Yeah.
classic drug dealer model. The first one is cheap, get them hooked.
It is a promotional aid, absolutely. A lender might offer a start rate that is substantially below the fully indexed rate. Let's say the index plus margin should be 7%, but they offer you 4% for the first year.
And the psychological trap here is just so obvious. You get used to paying that 4%. You budget for 4%. You buy a new car, assuming your mortgage is based on 4%.
And then the adjustment period ends, the teaser expires, and suddenly you are hit with the reality of the market. This is what the industry calls payment shock.
And it's a double whammy, right?
It is. It isn't just that the underlying index might have gone up. It's that the artificial subsidy the bank was giving you was removed at the same time, so you get hit twice.
So that adjustment timeline is crucial. How often does this actually happen?
It varies a lot. You have the adjustment period, which dictates how often the rate resets. It could be every single month, it could be every year, or every 3 years.
Every month. That sounds exhausting. I'd be checking the financial news every morning in a cold sweat.
It creates immense uncertainty. But there are guardrails, and this is where we need to get into the math, because understanding these guardrails or caps is the difference between an annoying increase and, well, bankruptcy.
Okay, let's talk caps. The source breaks these down into a structure, usually 3 numbers, like X, Y, Z. I want to pause on the math here because I think this is where people get really hurt.
It is.
We see these numbers in our mortgage documents, 2/2/6. It looks like a locker combination. So let's role play this. Let's say I borrow $500,000 on an ARM. My start rate, the teaser, is a nice low 4%.
Okay, so at 4% on a 30-year term, your principal and interest payment is roughly $2,387, manageable for a decent income.
Right, I can do that. Now, the first year ends. The teaser is gone. And let's say it's a bad year. Inflation is rampant, the index has jumped up by 3%, my margin is 2%, so the formula says my rate should now be my index plus margin, which is 9%. That's a huge jump.
It is. A jump from 4 to 9% would be devastating, but your initial adjustment cap, that's the first number in that 226 sequence it steps in.
It's the first 2.
That first 2 points means your rate is physically prevented from jumping all the way to 9%. It can only increase by a maximum of 2 percentage points on that very first adjustment. So 4% plus 2% equals 6%.
Okay, so I'm saved. My rate only goes to 6%, not 9.
For this year, yes. Your payment now jumps from roughly $2,400 to about $3,000.
That's a $600 a month increase. That hurts. I might have to cancel a vacation, maybe eat out less, but I'm not homeless.
But here is the danger. The market rate is still 9%. You are effectively being subsidized by the cap for this year. So if rates stay high, next year, the periodic cap, that second number, the second 2, allows another 2% jump.
So I go from 6% to 8%.
Exactly. And your payment goes up again, and then again the year after that, until you finally hit the market rate or you hit the lifetime cap, the third number.
The 6th in our example.
That 6/4 means your rate can never go more than 6 percentage points above your original start rate. So your 4% start rate plus the 6% cap equals a 10% maximum. That's your doomsday number.
So at 10%, my payment would be nearly $4,400. That's almost double where I started.
Exactly. Even with caps, which are supposed to protect you, your payment can double. That is the risk you accepted for that lower initial rate.
That is terrifying, but at least I can calculate the absolute worst-case scenario.
Yeah.
But, and here's where it gets really murky, there is a distinction mentioned in the source between a rate cap and a payment cap. And confusing the two seems like it could be disastrous.
This is one of the most dangerous misunderstandings in the world of mortgages. A rate cap limits the interest percentage, like we just discussed. A payment cap limits the dollar amount your check increases.
Okay, so give me an example.
Let's say you have a 7.5% payment cap.
Yep.
Your payment is $1,000 a month. This cap means it can only go up to $1,075 next year, no matter what happens to interest rates.
That sounds great. It protects my wallet. I know exactly what my budget needs to be. It feels safe.
It protects your cash flow, yes, but it does not protect you from the interest. If the underlying interest rate spiked, and the interest the bank is actually owed for that month is, say, $1,500, but you only paid $1,075, what happens to that difference?
I assume I still owe it. The bank's not just going to forget about it.
You do. You are short $425. The bank doesn't just forgive that. They take that $425 of unpaid interest and they add it to your principal loan balance.
So my mortgage gets bigger. I paid my bill on time, but my debt went up.
Correct. This is called negative amortization. You are making payments, but you are going deeper into debt every single month. It's like running on a treadmill that's slowly tilting backwards.
That is a nightmare scenario.
Yeah.
You could pay for 5 years and owe more than you bought the house for in the first place.
And that leads to massive equity erosion. If housing prices drop at the same time, which, by the way, often happens when interest rates are rising, you can find yourself underwater almost instantly. You can't sell, you can't refinance, you are completely trapped.
We're going to get deeper into that, specifically with option ARMs in a minute. That feels like the true crime section of this deep dive.
Yeah.
But I want to look at the menu available to borrowers first, because ARMs aren't just one thing. There are different flavors.
Right. And the most popular flavor, especially in the last 2 decades, is the hybrid ARM.
This is pitched as the best of both worlds, right?
That's the pitch, in theory. A hybrid ARM is fixed for a set period, and then it starts to float. You see them listed as 31, 51, 71.
Right.
The first number is the number of years the rate is fixed. A 51 is fixed for 5 years. The second number is how often it adjusts after that period ends. So a 51 is fixed for 5 years, then adjusts every 1 year thereafter.
I was reading in the source that the popularity of these just exploded. In 1998, they were less than 2% of all loans. By 2004, it was almost 30%. Why the sudden surge?
It was a sweet spot for the psychology of the American homebuyer at the time. People looked at the data and said, I'm probably going to move in 5 or 7 years anyway. The average American moves every 7 years. Why am I paying the premium for a 30-year fixed rate if I'm only going to be in this house for 5?
So they're gaming the system.
They are. The hybrid ARM gave them a lower rate than the 30-year fixed, guaranteeing that low payment for the entire time they plan to own the home. It seemed like a no-brainer.
It's a bet on your own life plans. You're betting you'll sell the house or refinance before that crucial date, the reset date.
The reset date is the cliff edge. That's the day the clock strikes midnight. If you are still in that house on that date, the loan transforms from a safe, predictable, fixed animal into a volatile, variable beast.
A lot of people lost that bet in 2008 and 2009.
A lot of people.
Now, let's talk about the product that really defined the bubble era for so many people, the option ARM, also known as the pick-a-payment loan. This feels less like a loan and more like a carefully constructed trap.
This is a complex financial instrument that was, believe it or not, originally designed for very sophisticated borrowers, people with extremely lumpy incomes like commission-based salespeople or seasonal workers. Imagine a wealthy entrepreneur who makes $500,000 in December, but basically zero in January. The idea was flexibility.
But it went mainstream in a big way.
It did, and here is how it worked. Every month, you get a bill with 4 choices.
Walk us through the 4 options on the menu.
Option 1, a 30-year, fully amortizing payment. This is like a normal mortgage payment, paying both principal and interest. Option 2, a 15-year amortizing payment if you want to pay it off faster. Option 3, interest only. You're just paying the rent on the money you borrowed, but you're not paying down the actual debt.
Okay, and then the 4th one, the dangerous one.
And option 4, the specified minimum payment.
And human nature being what it is.
Almost everyone chose number 4, the minimum payment.
But that minimum payment was based on that super low teaser rate, wasn't it?
Yes, often as low as 1%. So imagine opening your bill. You owe $500,000 on your house. The full payment is $3,000. The minimum payment is $1,200. And you've got a car payment, your kids are in braces, groceries are expensive.
I'm clicking the $1,200 button. Every single time, no question.
Exactly. But the actual interest rate on the loan isn't 1%. It might be 6 or 7%. So that difference, that $1,800 in interest that you didn't pay, it doesn't just vanish.
The bank adds it to the loan.
They add it right onto the principal. So next month, your mortgage isn't $500,000 anymore. It's $501,800.
And the month after that, it's $503,600. You are literally borrowing more money from the bank each month to pay the interest on the money you already borrowed.
And eventually that bucket has to overflow. The math is relentless.
This is the recast. This is the moment the music stops.
This is the moment. The contract says, okay, this has gone on long enough. And there are 2 triggers for it. One is a time trigger, usually every 5 years. The loan will automatically recast. But the scary one is the balance trigger.
The neg am cap.
The negative amortization cap. The contract says if your loan balance grows to, say, 110 or 125% of the original loan amount, the loan automatically recasts right then and there.
And what does recast mean in plain English for the borrower?
It means the party is over. The bank completely recalculates your payment to be whatever it needs to be to pay off the entire new, larger balance over the remaining term at the full interest rate. No more minimums, no more choices.
That must be a massive, massive jump.
It's colossal. We're talking about people going from paying that comfortable $1,200 a month to $3,500 a month, literally overnight. That is the ultimate payment shock.
And because you've eaten away all your equity, or worse, your loan is now bigger than the house is even worth, you can't refinance. You're completely trapped.
This one mechanism is what caused hundreds of thousands of foreclosures in the financial crisis.
It's incredible that this was ever a mainstream product. It seems almost designed to fail.
It was sold on the dream of affordability. Get into the house of your dreams for only $1,200 a month. But it was structured on a foundation of pure risk.
There's also something mentioned called a cash flow ARM. Is that just another name for the same thing?
It's very similar, yes. It focuses on that minimum payment flexibility for the first few years. The source notes that some fixed-rate loans even had these cash flow options built in, but generally when we hear cash flow ARM, we are talking about that same dangerous mechanism, prioritizing low monthly outflow at the cost of a rapidly rising debt balance.
Okay, so we see why a borrower might fall for this. Lower payments, qualifying for a bigger house, it's the American dream on easy mode. But why do banks push these? I mean, surely they know that a huge percentage of people will default. You mentioned earlier the asset-liability mismatch. Can we dig into the economics from the bank's perspective here? Why do they need ARMs to exist?
This is fundamental to understanding banking, and it explains why the bank isn't necessarily being evil in creating these. They are, from their perspective, just trying to survive.
Okay.
Banks are essentially middlemen. They borrow money from depositors, that's you and me putting money in a checking or savings account, and they lend that money out long-term to home buyers.
Right. Simple enough.
But deposits are short-term liabilities. You can walk into the bank and take your money out today. The bank has to pay you a short-term interest rate on that savings account. A mortgage, however, is a long-term asset. It sits on their books for 30 years.
So the bank is borrowing short and lending long.
Exactly. And that creates a dangerous mismatch. Imagine a bank in 1975 lends out billions in mortgages at a fixed 4% for 30 years. But then, in the early 80s, inflation goes crazy. To keep depositors from pulling all their money out and moving it to a competitor offering higher rates, the bank has to start paying them 6, 7, 8% interest on their savings accounts.
So the bank is paying out 8% to get the money. But they're only collecting 4% from all those old mortgages. They are bleeding cash on every single loan.
This is exactly what happened during the U.S. savings and loan crisis. Paul Volcker, who is the Fed chairman, jacked up interest rates to fight inflation. The cost of funds for banks skyrocketed, but all their income was locked in those low fixed-rate mortgages from the 70s.
And the banks just collapsed.
Thousands of them failed. It was a complete catastrophe. So the ARM is the bank's immune system against that ever happening again.
Ah, I get it now. It's a survival mechanism. By using ARMs, the bank matches its income to its expenses.
Yes. If rates go up, they have to pay depositors more, true. But they also start collecting more from the ARM borrowers almost immediately. It stabilizes their profit margin. It saves the bank by passing that volatility directly to the homeowner.
That really clarifies the why. It's not just predatory greed, although that's part of it. It's structural survival for the banking industry. They are terrified of being caught holding the bag again, like they were in the 80s.
Precisely. They're transferring what we could call the Volcker risk directly onto your shoulders.
Before we get to the scandals, and I really want to get to the scandals, I want to zoom out for a second. Because reading this source, I realized that my view of mortgages is very, very American-centric. I just assumed everyone did the 30-year faith thing. But that's not the case globally at all, is it?
Not even close. In fact, the United States is the global outlier. We are the weird ones. Here, the adjustable rate mortgage is almost a dirty word. It implies a government-regulated product that you only take if you have to. But you go to the UK, variable rates are the norm.
The norm. So everyone just accepts that their payment might change month to month.
Yes, absolutely. In the UK, borrowers are very focused on the current monthly cost. They ride the wave. If the Bank of England raises rates, Everyone in the country feels it in their mortgage payment almost instantly, and they tighten their belts. It actually makes monetary policy very effective because it hits household spending immediately.
Wow.
The same is true in Australia and New Zealand. Variable rates are the standard way to buy a home.
What about Canada? They're our neighbors. Surely they're similar to us.
There's sort of a middle ground. In Canada, you might get a fixed rate, but it's usually only fixed for 5 years, maybe 10 at the absolute maximum. The amortization of the loan is 25 years, but the rate isn't locked for that whole time.
So they have to renew it.
You have to renew the loan at the new market rate every 5 years. So they are effectively rolling over hybrid loans constantly. They don't have that 30-year security blanket that we cherish so much here.
And the source mentions Germany and Austria have a completely different model. The Bausparkassen. What is that?
This is a fascinating cultural difference regarding debt and saving. The Bausparkassen are building societies. The model there is you have to save first. You agree to put money into a special savings account at a low fixed interest rate for years.
So you are lending to the bank first at a low rate.
Essentially, yes, you're building up capital in their system. And once you have met your savings quota, you are guaranteed a low fixed rate loan for the rest of your life. It's a closed system.
What's the advantage?
The advantage is absolute certainty. Your payment never changes. The rate is locked forever. The disadvantage is you have to plan years and years in advance. It's aimed at the once-in-a-lifetime homebuyer who plans to stay put.
It doesn't sound very flexible for the modern worker who might move every 4 years for a new job.
Exactly. It struggles with modern mobility. It's a very different mindset.
Let's look at Singapore. The source goes into some specific detail there. They call them floating rate packages.
Yes. And they use very transparent indices usually. The SIBOR, that's the Singapore Interbank Offered Rate, and the SOR, the swap offer rate. Very clear benchmarks.
And the structure there seems to be a progressive spread or margin.
Right. This is interesting. They often structure the margin to increase over time. So year 1 might be SIBOR plus 0.75%. Year 2, the same. But then in year 4 and onwards, it jumps to SIBOR plus 1.25%.
That seems almost like a penalty for keeping the loan. It pushes you to pay it off.
It incentivizes you to pay it down or refinance. It's a subtle nudge from the bank saying, we don't want this small margin loan on our books forever. And there was a unique innovation mentioned there. ANZ Bank introduced a loan pegged to the average of SIBOR and SAVAR.
Why average them? What does that do?
That's an attempt to smooth out volatility. By averaging 2 different indices, you dampen the spikes. If one jumps and the other stays flat, the borrower doesn't feel the full hit. It's a clever bit of financial engineering to make the product a little safer.
It really shows that the way we pay for our homes is not a law of nature. It's a product of local banking laws and national culture. We think the 30-year fixed is the only way, but most of the rest of the world thinks we're crazy for even offering it.
Absolutely. The 30-year fixed is essentially a government-subsidized anomaly kept alive by Fannie Mae and Freddie Mac.
Okay, we have delayed this long enough. We have to talk about the dark side. Because when you build a machine this complex with indices, margins, look-back periods, caps, floors, triggers, things can break.
And they break. They break often. The source material here contains some truly shocking statistics about just simple calculation errors.
This is the back office disaster.
It is. I mean, think about it. In the pre-digital age, or even in the early digital age, a loan servicer had to manually track the index date. They'd have a note saying, okay, this loan adjusts on November 1st, looking back 45 days.
That sounds incredibly specific and easy to mess up.
It is. They have to find the LIBOR rate on exactly September 15th, not the 14th, not the 16th. Then they have to apply the correct margin, then check the initial cap, then check the periodic cap, check the lifetime cap, check for a payment cap.
And they are doing this for thousands and thousands of loans, all with different terms.
Millions of loans. And people make mistakes. The source cites a 1991 GAO study, that's the Government Accountability Office. They audited a sample of 8 ARMs and found that 20 to 25% of them had interest rate errors.
1 in 4.
1 in 4 was calculated incorrectly. And the financial impact was $10 billion in net overcharges to homeowners.
That is massive. That's $10 billion basically stolen from homeowners, mostly by accident.
Mostly by sheer incompetence and complexity. But it gets worse. A 1995 government study concluded that 50 to 60% of all U.S. ARMs contain calculation errors.
Wait, stop. You need to repeat that. Half. You're telling me that it's possible that half of the adjustable mortgages in the country were calculated wrong?
According to that government study, yes, a coin flip. Total overcharges were estimated in excess of $8 billion, and the causes were just mundane clerical errors. The wrong index date was selected, an incorrect margin was applied, the caps were ignored, just simple data entry errors that cost people thousands and thousands of dollars.
That is terrifying because most people just pay the bill. You assume the bank's computer knows math. If I get a statement from a major bank, I don't get out my calculator and look up the historical LIBOR rate from 45 days ago. Who does that?
Nobody does that. We assume the computer is right, but the computer is only as good as the data and the programming that was entered into it. And with ARMs, the complexity just breeds mistakes. If a clerk hits the wrong key and your rate is off by just 0.125%.
You think, oh, that's just pennies.
It's pennies this month. But thanks to the magic of compound interest and the fact that this error sets the new baseline for every future adjustment over 5 or 10 years, that single keystroke could cost you $10,000 or $15,000.
And the bank never catches it or never admits it.
Well, the errors are usually in their favor. There's not much incentive to go looking for them.
And it wasn't just errors. There was, of course, predatory lending. We touched on this with the option ARM, but the scale of it, it's breathtaking.
This is where the intent turns from incompetent to malicious, especially in the years leading up to 2008. The source notes that in 2006, over 90% of all subprime mortgages were ARMs.
90%. So the most vulnerable borrowers were given the most volatile product by design.
These loans were sold to people who the banks and brokers knew for a fact could not afford the fully indexed rate. They could only afford the teaser. The business plan was never for them to pay off the loan.
So what was the plan?
The plan was for them to refinance or sell the house at a profit before the reset date hit. It was a giant game of musical chairs fueled by ever-rising home prices.
And when the music stopped and house prices started to fall,
They couldn't refinance, they couldn't sell, the reset hit, the payment doubled or tripled, and the foreclosures started like an avalanche.
there's also a specific scandal mentioned in Ireland, the tracker mortgage scandal. This one really, really boils my blood because it's so brazen.
This is a classic case of banks trying to change the rules of the game when they start losing. In Ireland, tracker mortgages were very popular. They were tied directly to the European Central Bank, or ECB, rate.
Okay.
When the ECB slashed rates to basically zero after the crisis to stimulate the economy, these mortgages became extremely unprofitable for the Irish banks.
So the banks were losing money on them because the rate was too low. They made a bad bet.
Yes. They were stuck receiving tiny interest payments. And instead of sucking it up, remember, the contract is supposed to hold risk for both sides, the banks deliberately and systematically moved customers off these products in what the Central Bank of Ireland later called an adverse manner.
How did they do that?
They would call people and offer them a better deal to switch to a new fixed rate, which was actually higher. Or they would deny them their contractual right to return to the tracker rate after a period of fixing was over. They essentially just lied and forced people onto higher variable rates to boost their own profits.
So they cheated. They realized the bet went against them, so they just flipped the table over.
It resulted in a massive, years-long investigation. It's a stark reminder that in the borrower-lender relationship, the power dynamic is just so heavily skewed. The bank has the lawyers, the data, and the control.
It really emphasizes that you have to watch your lender like a hawk. You cannot be a passive participant in this.
You absolutely cannot. You have to be your own advocate.
Let's touch on a couple of technical nuances before we wrap this all up. Prepayment. This seems like a bright spot.
Right.
Can I pay off an ARM early without getting hit with a penalty?
Generally, yes. Most ARMs allow you to pay extra principal without a penalty, though you always have to check the fine print for specific penalties in the first 3 to 5 years. But there is a nuance to how it helps you that is different from a fixed loan.
How so? What's the difference?
If you prepay principal on a standard fixed loan, you shorten the term. You might knock years off the end of the loan, but your required monthly payment stays exactly the same.
Right.
On an ARM, because the payment is recalculated at every adjustment period, prepaying principal often lowers your required payment at the next adjustment.
Oh, that's interesting, because the calculation is based on the new, lower remaining balance.
Exactly. The loan essentially re-amortizes itself over the remaining term at the lower balance every time it adjusts. So if you come into some money and pay down $20,000, your required monthly payment will actually drop at the next reset. It improves your cash flow immediately rather than just shortening the far-off loan end date.
That's a useful feature if you're trying to manage your monthly budget flexibility.
It is. It gives you a knob to turn, a little bit more control.
And finally, pricing. How do banks even figure out if these complex loans will make them money? It just sounds like pure chaos with all these moving parts and caps and indices.
They use brute force mathematics. The source mentions they use Monte Carlo simulations.
Like the casino in Monaco?
Similar concept. They run 10,000, maybe 100,000 computer simulations of possible future interest rate paths. What if rates go up 1% a year for 5 years? What if they drop? What if they stay flat? What if they spike violently and then drop?
So they are playing out every possible multiverse scenario for the economy.
They calculate the bank's total cash flow and profit for every single one of those scenarios to find the fair value and the effective interest rate of the loan. So when they offer you a rate, they have mathematically proven to themselves that on average, over all those tens of thousands of futures, they will win.
So they have played out the next 30 years 10,000 times before they even offer you the loan. Meanwhile, you are just guessing based on what your brother-in-law told you about the economy.
Exactly. It is the definition of asymmetry of information. They have calculated the odds down to the hundredth of a decimal point. You are walking into the casino blind.
That is humbling and a little terrifying.
It is. It's why understanding the rules of the game is so important.
Okay, let's try to land the plane here. We've covered the mechanics, the risks, the history, the global context, and the scandals. What does this all mean for you, the listener?
It means that an adjustable rate mortgage is a powerful tool, but it is a very, very sharp tool. I like to think of it like a chainsaw. It can cut down a tree very efficiently, or it can cut off your leg. It is not a set-it-and-forget-it product like a fixed mortgage. You are entering into an active partnership with the financial markets.
You are the shock absorber.
You are, and the trade-off is crystal clear. You get a discount on your payment today in exchange for taking on the risk of inflation tomorrow. If you understand that risk and you have the cash reserves to handle a payment shock, it can be a savvy financial move. The scholarly view supports that. If you have the financial resilience to weather the storm, the ARM often wins in the long run.
But if you are stretching every dollar just to afford that low teaser rate,
Then you are walking into a trap. Whether it's a simple rate reset, a cap breach, or that dreaded negative amortization recast, the math will eventually catch up with you.
and you can't even trust that the math on your statement is correct.
No. And that, for me, is the biggest takeaway from all of this. The complexity of these products is so high that even the banks, with all their resources, struggle to administer them correctly.
Which brings us to our final provocative thought.
It does. We live in a world of automated finance. We click accept, we set up auto pay, and we assume the institution has it right. We put our faith in the algorithm. But history, specifically that 1995 study showing a 50 to 60% error rate, suggests that faith might be misplaced.
So here is the question for you listening right now. If you have an ARM, or if you had one in the past, have you ever actually audited the bank's math? Did you ever go back and check if they used the right index on the right date? Did you check if the margin was added correctly? Did you verify every single cap?
Because in a game where the house has already calculated how to win, the one time they might be variably wrong, either in your favor or more likely against it, is in the fine print of that monthly calculation.
Maybe it's time to get out the calculator and that old contract. Thanks for listening to The Deep Dive.
Stay curious.